Joining me now is Michael Scordelis, head of U.S. Economics at NYSE-listed Truist. Michael, welcome.
Thanks for having me, Ashley.
So what are you watching most closely as this week's trading officially gets underway?
Well, it's the release of data. So we had the shutdown. It impacted a lot of government source data. It's not the only data that we get, but it is the primary source of a lot of the more robust data that we analyze. So not having it for the past 7-8 weeks is a big deal. So getting it back is going to be a big deal going forward. So starting this week.
All right, and according to the latest data, less than half of traders are pricing in the chances of a rate cut when the Fed meets in December. What do you think we're going to see?
So we've been saying prior to the shutdown that it was going to be December or January, not both as far as rate cuts. And now that we haven't had data, and the data, vacuum, if you will, is causing an issue for the Fed. And being data dependent, they need data. So not having that key data, I think, probably opens the window for them to take a pause in December and perhaps wait until January.
All right, and we understand Truist's base case when it comes to the Fed is 125 basis points in rate cuts by the end of 2026. What path do you see in getting us to that figure?
Well, the first thing is, from a pace perspective, it's going to continue to be gradual. So quarter point increments on the way, but it's likely to, again, it's either this December or January. We think it's January, but then likely to be March, June, and somewhere in first half is where it's the bulk of that is going to be concentrated. We wouldn't look for larger 50 basis point increments or anything like that. It's likely to continue to be rather gradual. And again, I think that's appropriate given the overall environment for the economy.
All right, and you spoke about data earlier, and following the reopening of the U.S. government last week, the BLS says it's going to release the September jobs report on Thursday. How much of an impact do you think this is going to have on markets, given that we're in mid-November?
Well, September data is so far in the rearview mirror, Ashley. I don't think that traders are going to care very much. The difficulty that we're going to have, and I think it's going to complicate the Fed's December 10th meeting, is that we're likely not going to get a clean view economically as far as data through the remainder of the year. It's likely that we wait until we get to early January or even mid-January, depending on the data point, for us to get a clean read because of the shutdown and the disruption in data.
All right, and what do you expect to see when this report is released?
Well, we expect a pretty decent number, but it's going to continue to be sluggish and dependent on a number of sectors. That said, it's very likely that it's going to be a downward number for government, especially federal government. We know that a lot of those DOGE-displaced job cuts are likely to hit here September, October, November, perhaps even into December. That's going to be a drag on overall growth. That said, we're a little concerned that when we look ahead, as far as the October, November data, which we're not going to get for a while, but that some of the, if you will, usual suspects, retail, warehousing, and couriers, that those perhaps might be a little bit lighter than typically we see this time of year.
And how significantly, do you expect the shutdown to impact Q4 GDP growth? And how much growth do you foresee for 2026 in that area?
So let me start with the first part, the last part first, which is we expect an uptick in growth, right? So roughly 1.9% in 2025. We think there's an uptick to about 2.2%. There's three primary reasons why we think that happens. One is the impact from the one big beautiful bill. So some economic stimulus coming from that, both for consumers and for businesses. The second piece we mentioned earlier about a little bit of fiscal stimulus from the Fed, so modestly lower rates, but not in a big way, but modestly lower. And then the third one is on the tariff front. We think that the tariff uncertainty, well, it doesn't completely lift. We think that it kind of moves into a more like steady state, more stability that lets decision makers and companies plan. So we see an uptick there. That said, the fourth quarter actually is likely to be pretty sloppy. Some of it has to do with the shutdown. Some of it also has to do with shutdown related impacts. So things like not having full flights going through. That means not just the flights, but missed hotel stays, not going to restaurants, and other things that people do when they go on the road. So not as many people flying for several weeks is definitely going to have an impact. Additionally, air carriers, so the FedEx and the UPS and DHL and these other air carriers that do air cargo, they were impacted as well. So that means you're going to have a backup in some of these things. That's going to be some of that sloppy numbers that I was talking about.
All right. Thank you, Michael Scordelis, head of U.S. economics at Truist.